When most of us think about investing, it's a lot like driving a car, where you only have two pedals and absolutely no gears.
Right, just the gas and the brake.
Yeah, exactly. You're either slamming your foot on the gas, going all in on whatever the market is doing right this second, or you're slamming on the brakes, pulling everything into cash because you read one terrifying headline on your phone.
Which is an incredibly binary way to navigate your financial life. I mean, you are either choosing total heart-pounding risk or total growth-killing safety.
With zero nuance in between. But what if your portfolio had an automatic transmission? A system that could smoothly shift gears for you up and down based on the actual conditions of the road.
Without you ever having to jerk the steering wheel in a panic.
Right. And that is exactly what we are exploring in this deep dive. So our mission today is to crack open the actual performance data of Hush's 3 ETF portfolio strategies. That's the Protector, the Strategist, which they also refer to as Pure Global, and the Adventurer. We are evaluating their track records right up through the specific end date of June 30, 2026.
Before we dive into the mechanics of those portfolios, though, we do need to address how these financial numbers are reported. Every single return figure we discuss is strictly net of fees.
Okay, so what does that actually mean for the listener?
In this specific case, that means a 0.75% annual advisory fee has already been factored into the performance data we're about to analyze. What you hear is what an investor actually got.
Right, so no gross return fluff.
Exactly. Furthermore, and this is crucial, past performance is not a reliable indicator of future results. We are not making any forward-looking statements today.
So no predicting the future.
No predicting the future.
Yep.
We're not projecting where the market is going next year, and we are absolutely not offering individual stock-picking advice. Our focus is purely on the historical data up through June 30, 2026.
By insisting on net of fees, we're stripping away the hypothetical stuff and looking at the mathematical reality. And so let's unpack the engine behind that discipline. The overarching strategy we're looking at was designed by Chief Investment Officer Andreas Clinau. On the surface, the rulebook seems pretty restrictive, actually.
Very restricted by design.
Right. Hush uses entirely exchange-traded funds, which most of you listening know as ETFs. They don't buy individual stocks. Instead, they have a universe of about 80 carefully selected ETFs, and every one is traded in U.S. dollars on American exchanges.
And that restriction to U.S. dollar-denominated ETFs is a very intentional structural decision.
How so?
Well, it means you get broad exposure to international markets, places like Europe, Asia, Latin America.
Yeah.
But without the added friction and cost of dealing with foreign currency exchange rates.
Oh, that makes sense.
Right. And by restricting themselves to these 80 ETFs, they eliminate layers of risk. I mean, there is no individual stock picking, meaning you aren't ruined if one single company goes bankrupt.
And no leverage either, right?
Exactly, no leverage. So they aren't borrowing money to amplify returns, which, as we know, also amplifies losses. And there is absolutely no shorting. They simply divide the investable world into a logical structure where one ETF represents a specific country, another represents an economic sector, or a type of bond.
And then they offer this exposure in 3 distinct tiers, which is where that automatic transmission comes into play. They manage different risk appetites using those 3 portfolios we mentioned: the Protector, Pure Global, and the Adventurer.
Yeah, and we should probably get specific on how these gears actually differ underneath the hood.
Let's do it.
It entirely comes down to asset allocation.
Yeah.
Specifically, how much exposure you have to the stock market versus bonds and alternative investments. The stocks are inherently more volatile, right? They bounce around a lot more.
Right, you feel the bumps.
Exactly. So the Protector portfolio, which is our first gear, holds the absolute lowest amount of stocks. It favors less volatile assets like bonds. It is mathematically designed for lower risk and capital preservation.
Okay, so that's the safest route.
Then you step up to the middle ground, the Strategist or Pure Global. This balances stocks, bonds, and alternatives more evenly to capture growth while maintaining a safety net.
And then the third gear.
Finally, you have the Adventurer. This tier holds the highest stock allocation, which obviously carries higher volatility, but targets the highest potential returns.
But what makes Hush's approach unique isn't just that they offer these 3 static risk tiers. It is how they manage the money actively inside those tiers using a system they call dynamic momentum.
Right. They aren't just buying these 80 ETFs, closing their eyes and hoping for the best. It is an active engine.
But momentum is a tricky word in finance, isn't it?
It is.
Yeah.
Often people think momentum just means buying whatever's going up the fastest.
Like chasing a meme stock just because it jumped 20% yesterday?
Exactly. Hush's algorithm works differently. It constantly measures the strength of price trends across all 80 markets they cover. But the crucial mechanism here is that they are measuring the health of the price trend on a risk-adjusted basis.
Which is a very specific methodology.
Andreas Klenau actually detailed it in his 2015 book, Stocks on the Move.
So how does the algorithm define health?
Think of it like a marathon runner. You don't just want a runner who sprints wildly for 100 yards, stops to catch their breath, and then sprints again.
Because that's too erratic.
Right, that is high volatility. You want the runner who maintains a strong, incredibly steady, consistent pace mile after mile.
Okay, I see.
The algorithm looks at the slope of an asset's price over time and actively penalizes assets that are too volatile, even if they are going up. It rewards smooth, steady climbs.
So it's looking for stability in the growth.
Exactly. Once it identifies those healthy trends, it dynamically shifts the portfolio weightings to those strongest markets without abandoning the core principle of global diversification.
Okay, I think I have the mechanics down. If European markets are displaying a smooth, healthy climb, the automatic transmission shifts more power to Europe.
You got it.
And if commodities start behaving erratically and getting sick, it downshifts exposure there.
Yep, it adapts.
So, knowing how the engine works, let's look at the actual mileage these portfolios got on the road leading up to June 30, 2026. Let's start with our baseline, the defensive gear, the protector portfolio.
Let's break down the exact performance data from the reports.
Right, looking at the protector, the exact dates we have are August 1st, 2024 to June 30, 2026. The net of fees returned since inception was a positive 22.25%. The one-year trailing return was plus 12.25%. Now, for the year-to-date in 2026, the specific reporting metrics show plus 5.59% in the performance summary. But to understand if that's actually good or bad, we have to look at the benchmark they use, which is the iShares Core Growth Allocation ETF, ticker AOR.
Always need a benchmark.
Exactly. For this exact period, from August 4, 2024, the AOR benchmark returned plus 25.06% and plus 7.42% year-to-date. But here's what immediately catches my eye. The protector actively underperformed its benchmark. It trailed by 2.81 percentage points since inception.
So I have to play devil's advocate here. Why on earth would you or any listener want to put your money into a strategy that loses to the benchmark?
It is the absolute right question to ask, and well, it's why context is everything when we analyze financial data. You have to remember the strict mandate of the protector portfolio,
Which is to play defense.
defensive by design. The benchmark, AOR, is a balanced growth allocation, meaning it leans into equities. During a massive, sustained global equity run like the one we saw leading up to 2026, holding intentionally fewer stocks is naturally going to cause you to drag behind a growth-focused benchmark. Because you intentionally took your foot off the gas. You can't win a drag race in first gear.
Exactly. But you have to look at what you bought with that 2.81% lower return. You bought a significantly smoother ride. The protector had a rolling volatility of 9.8% and a maximum drawdown of negative 9.63%. That slight underperformance is the mathematical cost of a good night's sleep.
The shock absorbers did exactly what they were built to do. You aren't paying for top speed, you are paying to not feel the potholes. So if the protector is our baseline for safety, yielding a modest, smooth return, what happens to the math when we allow the algorithm a little more freedom? That brings us to the Strategist, or pure global.
The middle ground. This is where we see how the dynamic momentum handles a balanced approach.
Yeah.
What did the dates and returns look like here?
The exact dates for Pure Global are May 2, 2024 to June 30, 2026. Inception to date, again, strictly net of fees, it delivered a plus 35.27%. The one-year trailing return was plus 19.21%, and year-to-date 2026 was plus 8.19%. Now let's stack that up against the iShares AOR benchmark for that specific time frame. The benchmark returned plus 32.84% and plus 7.42% year-to-date.
So here we see a totally different outcome. The dynamic momentum algorithm really proved its thesis in this tier. This middle gear successfully generated a 2.43 percentage point excess return over the benchmark since inception. It actively beat it.
Which proves that maintaining multi-asset stability across different global markets doesn't automatically mean sacrificing growth.
Right. By dynamically tilting the portfolio toward the healthiest price trends, Pure Global was actively able to capture the upside.
So if the middle gear beat the benchmark so efficiently by capturing the upside, what happened when they pushed the pedal to the metal? Let's talk about the adventurer.
The high-speed gear.
Exactly. The exact dates for the Adventure Composite are June 4, 2024 to June 30, 2026. Inception to date, net of fees, a return of plus 34.66%. The one-year trailing was plus 20.86%. Year-to-date 2026 was plus 10.49%. And against the iShares AOR benchmark for that specific window, the benchmark returned plus 27.91% and plus 7.42% year-to-date.
I mean, the Adventurer beat its benchmark by 6.74 percentage points over the period.
I have to push back here. We all know that higher returns always demand higher risk, right? There is no free lunch.
No free lunch, absolutely.
So if I'm an investor holding the Adventure and looking at a 6.74% outperformance, how painful were the actual drops I had to endure to secure that plus 34.66%?
You definitely felt the bumps to win that race. Because it holds more equities, the volatility for the Adventurer was noticeably higher, at 12.5%.
In the drawdown.
The max drawdown, so the biggest peak-to-trough drop in the portfolio's value during that time was mega to 12.92%.
But I want to look under the hood of these numbers, because the June 2026 market commentary gets very specific. What specific assets actually drove these numbers? When we look across the board, what was winning and what was dragging these portfolios down?
When you isolate the specific contributors for June 2026, the heroes of the portfolio were emerging markets, healthcare, and industrials.
Any specific standouts?
Specifically, Taiwan, which is traded under the ticker EWT, was a massive contributor. In the Adventurer portfolio alone, holding Taiwan added a positive 0.28% to the total return in just that single month.
It's exactly the kind of strong, sustained trend health this algorithm is built to find and ride.
Exactly. The algorithm just follows the health of the trend, and Taiwan was incredibly healthy. And it wasn't alone. That performance was supported by the Healthcare Select Sector ETF, XLV, and Industrials, XLI.
Any others?
You also had strong positive performance from Spain, EWP, and Financials, XLF, propping up the returns across all three tiers.
But the reality of a global portfolio is that it's never all green on the screen. The algorithm doesn't possess a crystal ball to magically prevent assets from losing value.
Right, there had to be some heavy anchors dragging the portfolios down.
What were they?
Well, global markets are deeply interconnected and highly complex. Oil, tracked by the ETF USO, was the primary detractor across the board.
How bad was it?
In the Adventurer tier, oil pulled total performance down by 0.53% in June alone.
Wow, that hurts.
It does. Similarly, agricultural commodities, tracked by GSG, detracted 0.30%. You also had Norway, NORW, base metals, DBB, and the broader Latin America ETF, ILF, all acting as macroeconomic drags on performance.
Okay, so this is where the theory of dynamic momentum finally hits reality. We know exactly what was winning: Taiwan, Europe, healthcare. And we know exactly what was losing: oil, agricultural commodities, Latin America. How did the algorithm actually respond to that reality?
This is the most fascinating part of the data because we can actually trace the exact allocation shifts. Let's use Pure Global as the case study for how the algorithm reacted in real time. Because the system constantly recalculates trend health, it recognized the strength in Europe and heavily increased its exposure there. It raised its weight in Italy, EWI, by 1.66 percentage points. It raised Austria, EWO, by 1.1 points.
And what did it do with the sick trends?
It ruthlessly cut them. Because commodities in Latin America were showing deteriorating, struggling trends, the algorithm aggressively reduced its weight. It cut agricultural commodities, GSG, by 1.24 percentage points, and Latin American equities, ILF, by 1.1 points.
I think the easiest way to understand this is to compare it to pruning a garden.
I like that analogy.
Yeah, like if you have a massive rose bush, you take your shears and you actively cut back the dying, yellowing branches, that is your commodities and Latin American equities in this scenario.
Right.
You cut them off so the root system can redirect all that water and nutrients to the branches that are actually blooming, which in this case were European equities like Italy and Austria.
That is a brilliant analogy. You do not panic and uproot the entire garden just because one branch is dying, which is honestly what human investors tend to do.
They panic sell the whole thing.
Exactly. Instead, you dynamically redistribute the resources to where the growth is healthiest. And the algorithm does this methodically, based entirely on math.
But it brings me to a critical point. We have been sitting here throwing around some specific, exact numbers for the last 15 minutes. Plus 35.27%, minus 1.24 percentage points.
We have.
In a world completely saturated with financial influencers on social media yelling about guaranteed 1,000% crypto returns and hidden stock secrets, why should you, the listener, actually trust these specific numbers from Hush?
If we connect this all back to the bigger picture, it entirely comes down to the strict regulatory environment we touched on at the very beginning of the deep dive.
The compliance rules?
It guarantees a level of transparency you just can't get on social media.
Right.
When Hush reports a plus 35.27% net return for Pure Global since inception, that is not a theoretical best-case scenario. That is the unvarnished mathematical truth of the model after the 0.75% advisory fee has been taken directly out of your pocket. The compliance forces reality.
When you zoom out and look at all these risk tiers side by side, the overarching theme isn't just about picking the right assets, it is about systemic discipline. You have the protector, acting as the heavy shock absorbers, preserving capital but intentionally lagging the benchmark.
Right, the defensive play.
You have Pure Global, the middle gear, perfectly balancing the scales and actually beating its benchmark through high efficiency trends. And you have the Adventure, which pushed the pedal down and outperformed by nearly 7 percentage points.
A really diverse spread.
But regardless of the tier, they all rely on the exact same disciplined, ETF-driven dynamic momentum engine. They captured major global equity upside in places like Taiwan and Europe, while ruthlessly pruning underperforming sectors like oil and agriculture without a second thought.
And what is truly fascinating here is what makes that ruthless pruning possible in the first place. It leaves us with a concept I really want you, the listener, to mull over long after this deep dive ends. Algorithmic trend following requires zero emotional input.
Zero. The math literally does not care how you feel about the news today.
Exactly. The hardest part of investing isn't actually finding a winning strategy. It is having the sheer psychological discipline to execute it when things get scary.
Which humans are notoriously bad at.
We are. An algorithm will stay in a highly concentrated, uncomfortable trade, like holding heavy, outsized exposure to Taiwan during a period of intense geopolitical tensions, because the mathematical trend health dictates it. Human instinct, driven by fear, stress, and terrifying news headlines, might panic and sell right before a major rally.
But an algorithm doesn't panic.
An algorithm doesn't panic. It just recalculates the slope of the line and shifts the gears.
So the question for you listening is this. How much of your own financial decision-making is actually driven by cold, hard data? And how much is just simple, raw emotion? Are you driving your retirement with a manual transmission, violently grinding the gears every time you get scared by the news? Or is it time to look for an automatic? Thank you so much for joining us on this deep dive. Keep asking the hard questions about your own financial strategies, and we'll see you next time.